Hey everyone, welcome to this review for the final exams for Busy 1004. So we're going to be covering shareholders equity first. The questions that you get for this chapter tend to be fairly simple. They tend to be one of the long answer questions, so you can expect one of them to be this. And it's fairly straightforward. There are only a limited number of journal entries that are involved. And as long as you know how to go through this, it's pretty easy to get marks for this question. Apart from that, if any of you have any questions or you'd like any help, you can always email me at my email here. And I'll try my best to help you. If it's too close to the exams, I have exams right around that time too, so I won't be able to help you. But if it's a little bit in advance, then I'll try my best to accommodate. And with that, let's get started. The best way to go about this is you look at the question yourself, try to solve it, see what you get. If you get stuck somewhere, you can come back to the video and see how we solve it. But apart from that, let's get started and see what's the best way to begin these questions. So for these questions, we have common shares and we have preferred shares. So the main difference between the two is that common shares get voting rights and preferred shares don't get voting rights. However, the dividends that preferred shares get are guaranteed, whereas common shares may or may not get dividends paid out to them. And we'll be keeping track of them separately. So let's see what our starting balances are. So we are told we have $7 preferred shares, non-cumulative, and 100,000 shares are outstanding, and 10,000, which correspond to $10 million. So we'll keep track of that. Let's call this preferred, spell that wrong. Preferred shares. On one side, we'll track the number of shares, and on the other, we'll track the dollar value of those shares. So we started off with 100,000 preferred shares, the value of which is 10 million. And it's nice to include here that they have a dividend value associated with it. So when it comes to common shares, they don't have a guaranteed dividend. So it's just up to the company what they pay out to common shares. But preferred shares have a fixed dividend that has to be paid out to them. And that is what this $7 figure here, that is what that represents. So this $7 that you see here, every question, when they say they've issued preferred shares, will also tell you how much dividends go along with that. So let me put down the dividend value here too. Which is $7 per share. Perfect. And we'll also keep track of common shares. So let's make a table for that too. Now the starting value for common shares, we are told 5 million of them have been issued. So let's put that figure down. And the value corresponding with that is 24 million. Okay. At the same time, we'll also track what happens to retained earnings, because a lot of questions may also ask you to create a statement of shareholders' equity right after. So we'll check what the retained earning, what changes are being made to the retained earnings as well. So let's do that here. This is just a simple T table. The value for retained earnings is credit 8 million. Okay, perfect. Now let's get started with the question. The very first part A tells us that we've issued 1 million shares, the dollar value of which is 6 million. So let's add those figures here. And the value for these is sorry, 6 million. I'm just going to move this down. Okay. Now, the first part tells us that we've issued all these shares. Let's write the journal entries for that. So 1, debit and credit. So our debit is in this case to cash because we're receiving cash, and our credit will be to common shares. And the amount is 6 million. Right? Now, next part 2 tells us that we've issued a further 5,000 common shares, the value of which is 3,400. So let's add 500,000 more shares to that, the value of which is 3,400. And let's put the journal entry. So we're receiving cash, so let's debit cash, and we are increasing number of common shares, we're issuing shares, so that's a credit to that. And the amount is 3,000. Okay. Now the next part tells us that we repurchased and canceled 100,000 shares, and the amount that we purchased them back at is $12 per share. So at this stage, what we have to do is we have to find the average share price. So let's calculate the total number of shares and then find the average share price. Just do some house cleaning here. Okay. So add up these three numbers. I'm going to do that on my calculator now. So we have 5 million to which we've added 1 million. So that's 6,500,000. And then we had 24 plus 6 plus. That gives us 33,400,000. Now that we know the total dollar value and we know number of shares, we can easily find the number of shares by dividing this figure by this. So 33,400,000 divided by 6,500, by 6,500,000 gives us an average share price of $5, and it says round it up to 2 decimals, so that is 5.14. So that's $5.14 per share. So now let's see what the journal entries are for repurchasing shares. So in this case, we have 2 debits and 1 credit. A common mistake people tend to make at this point is they'll see how much cash has been exchanged. So they'll do the $12 into 100,000 shares, and they'll debit common shares for the same amount and credit cash for the same amount. But that's not how you do it. Remember that when you're repurchasing shares, there are 3 journal entries involved. So the very first one, since we are paying cash, let's do that one first. So we'll be paying cash, that's a credit. At the same time, we are repurchasing, so we're reducing the number of common shares. We do that by debiting it. So we'll debit common shares. And lastly, there'll be a difference between the 2 values, which will flow to retained earnings. But first, let's see how much the difference is. So there'll be a retained earnings debit. Let's check out what our value for cash is. So the question tells us that we repurchased 100,000 of them at a dollar value of $12 per share, which corresponds to 1,200,000. So we'll credit our cash by 1,200,000. At the same time, our common shares are going down, and the amount that we're going to reduce our common shares by is using the average stock price that we've calculated. So at the time of the repurchase, we find our average stock price, which is 5.14, and we multiply it by the number of shares that we've repurchased, which is 100,000. into 100,000, which gives us 514,123. Okay. Now, as you can see, the credits and debits, there's definitely a difference. That difference will flow to your retained earnings account. So 1,200,000 minus 514,000 gives you 6,686. Nice. So this is how you do repurchase a share. You find the average share price. Your common shares get debited by the number of shares sold times the average share price. Then your cash goes down by how much ever the question tells you you paid for the share. And then whatever the difference between the two is, that flows to your retained earnings account. So let's go ahead and update the changes that we made here. So we've sold 10,000 shares, was it? 100,000 shares. The dollar value of which was 514,000. Okay, and let's make the retained earnings debit as well. So we debit retained earnings by 686. Okay. Now let's go to point 4. Point 4 tells us that we issued 50,000 common shares for land and building. The independent appraisal of the land and building indicated in the market value is $100,000 and $350,000. So in this case, instead of accepting cash for the common shares, we've issued them in exchange for some building and land. Just remember, if we are exchanging common shares for anything other than cash, we record the transaction at the value of the assets that we are gaining in return. So in this case, we're gaining $100,000 worth of land and $350,000 worth of building. So let's record these entries. So that's a debit. So instead of gaining cash, we are gaining a building and we are gaining land, and our credit will be to common shares that we are issuing. Let's see how much the land was worth. The land was worth $100,000. The building was worth $350,000. And you just add up the figures and 450,000. So let's go ahead and put the shares down here. We are told we've issued 50,000 shares. So plus 50,000. And the value of that is 450,000. So plus 450,000. Let's go to point number 5. So at point number 5, we split the stock. So a 2:1 stock split. What this means is we've doubled the number of stocks that were originally there, which means that the value of the stocks remain the same, just the number of stocks gets doubled. So let's see how many stocks we have at present after all the changes were made. So 6,500,000 plus 50,000 minus 100,000 gives us 6,450,123. And the value associated with this is 33,400 minus 540, so 33,400,000 minus 114,123 plus 450,000 gives us 333,336. 1, 2, 3. Okay. So at this point, we are doing the 2:1 stock split, which means that we are going to double the number of stocks. So we have 6,450,000. let's double that. So 6450, 123 into 2. That means now we have 12,900,000 shares, but the dollar value of that remains the same. So that does mean, since we've doubled the number of stocks and the value is the same, that means the stock price also gets halved. But we can just simply find the stock price by taking the total value and dividing it by the number of stocks that we have. So that's 33,336,123 divided by 12,900,000 gives us an average stock price of $2.58 per share. As you can see, it's pretty much the prior stock amount, approximately half. So the next part tells us that after the stock split, we've declared dividends on preferred shares. So this was number 5. So this is number 5 that we've done. So we are going to have journal entries for number 6. We've declared the dividend on preferred shares. Again, pay very close attention to the language here, because you'll always do declaring of the dividend and paying of the dividend as two separate journal entries. So it'll always be declared first and then it'll be paid out. So when you're declaring it, the journal entries involved are the journal entries involved with that are you'll be debiting retained earnings, and you'll be crediting dividends payable. So remember, anytime retained earnings is the amount of money that the company makes over the course of its operation. So whatever it does making money, this is all the money the company's made over its lifetime. And out of the money that we've made, we'll be paying out the shareholder some amount. So now we are told that we are paying off the preferred shares amount. We were told it was $7 per share. So let's see how many preferred shares we have. We have 100,000. We're paying each one of them $7. That's $700,000. So we're debiting retained earnings by 700,000 and crediting it also by 700,000. Let's go ahead and add that here as well. Okay. Now, the next one tells us that we've declared a dividend of 50 cents on all the common shares. So at this point, we need to determine how many common shares we have. This is the number of common shares we have, and each one of them is getting 50 cents. So let's see how much they're getting. So 12,900,000 divided by 2 gives you 6450. So let's see what our journal entries involved are. It's a debit to retained earnings. And it's a credit again to dividends payable. And the amount was 6,450,000, 6,450,000. Okay. So remember, whenever we are paying out dividends or we are purchasing back shares, we'll always be debiting retained earnings. So when it comes to equity, any outflow of cash will involve a debit to retained earnings. And at this point, we have the debit to retained earnings and the credit to dividends payable. At some point in the future, they have not asked this in the question, but in the exam, they might also tell you that at some later date, the dividends were paid off. So at that point, you will debit dividends payable and credit cash. since you're paying out cash for the same amount. But this question hasn't asked that, so let's just omit that for now. Okay, now that we have all the final balances, that's all that the questions asked us. But in our case, let's go ahead and also create a statement of shareholders' equity. I'll show you what that process looks like. So if you go back to your first lesson, you'll remember that the very first thing that you do when you're making a statement is you write down the name of the company. Let's check the name of the company here. It was Iris Corp. Followed by the name of the statement. So statement of changes to shareholders equity. And then the next line is your designation for the date. And this is for the year ending December 31st, 20x4. Perfect. Now that we've done this, let's go ahead and see what the statement of changes to shareholders equity looks like. The very first thing we're going to do is we're going to make the columns for it. And the columns are all the accounts that we have in shareholders equity. So we have common shares. We have preferred shares. And we have retained earnings. And whether you want or not, or the question asks you, you may either have a totals or some of them don't have this, and that's also okay. That kind of depends on what's asked of you. So this is what the columns are. Now the rows, the very first row has to be starting balance. So let's see what our starting balance values were. We were told $10,000 was preferred shares, $24 million was common shares, and 8 million was retained earnings. So let's go ahead and add the starting balances. Preferred shares, 10 million, common shares, 24 million, and retained earnings, 8 million. Perfect. And now for each row, you're just going to be, you'll go back to your journal entry and you'll start seeing what changes have been made to each of these accounts over time. And that is what our row titles will be. So let's go to the very first one. The very first thing that we changed that we made is we've issued shares. So let's go ahead and note that down. Let's call that issue of shares. Now let's calculate how many common shares we've issued. So the number of common shares issued are 1, 2, and 3, right? But these are the number of shares. Remember, in our journal entries and our statements, it doesn't matter what the number of shares are. What matters is the value that corresponds with them. So let's take each one of these. So first of all, we've added 1 million, sorry, 6 million, 3,400,000, and 450,000. So I'm going to add up those three numbers. That the value for that is 9,850,123. Okay. And now the next step is to, let's see what the next change after that is. The next change after that is we've repurchased some of the common shares. So let's put that down. repurchase of share. So again, during the course of the question, we've not issued any more preferred shares. And when we issue shares, nothing happens to the retained earnings, only when we repurchase shares. So let's see what the values for this are. So when we repurchase shares, it cost us 514,000. So let's add that value here, minus 514,000. But we've never repurchased any preferred shares. But when we did repurchase the share, it did affect retained earnings. So if you go back and see the journal entry, you can see that the retained earnings was reduced by 686,000. And now 686,000 is how much we again reduced it by. Okay, what other changes have we made in our journal entries? So we've issued land, but that already happened in issue of shares. Then we have issuing of dividends. As you can see, when we issue dividends, we have to pay it out of retained earnings. So we'll have to put down the value of this as this plus this. Let's go and write that down. Issue of dividend. When you issue dividend, it doesn't affect common shares. It does not affect preferred shares. It only affects retained earnings. So let's put down that value. That's 700,000 plus 6,450,000 gives you minus 7,150,123. And since that's all, like there is no other entry that we made, there's no other change that we made. This is all of them. So now we can give it the end balance. So at this point, we're just adding up the table. So 24 million plus 9850 minus 515 gives us 33,336,123. Right? That's the same value we have here. Then for preferred shares, there were no changes that were made, so it remains at 10 million. And now let's find the retained earnings. 8 million minus 686,123 minus 7,150,123, which gives us a total of 164,123. Perfect. Another change that could have possibly been included here would have been net income. So if we were told how much that net income amount was, we would then have to add another table. So just for the sake of completeness, in case some of the other questions may have that, let's also put net income here. So net income is never going to affect common shares. It'll never affect preferred shares, but it will increase the amount of retained earnings. So it'll increase the amount by whatever the net earnings is, the net income is. But in this case, it's 0, so we don't have to worry about that. And that is your statement of changes in shareholders' equity complete. Now the question after this might even ask you to create a partial balance sheet. When you have to do that, all you have to do is, again, name of the company, Iris Corp. So when they mean a partial balance sheet, they just want the equity section. Then you have the name of the statement, which is your statement of financial position. And you can either write partial statement of financial position, and the date is as at December 31st, 20x4. Okay, and now you're just doing the equity section. So let's just write equity here. And now all we are doing is we're just stating these three numbers. So our common shares, we're just showing the end balances. Common shares, 33336 Preferred shares, 10 million. And retained earnings, of 164.23. And then you can just add these numbers up and say total equity. You just add all the numbers up and find the total here. They may not ask this last part, but it's good for you to know how to go about it, because we've also covered this in chapter 1, if you remember, when we'd done or whatever the chapter was. I think it was either week 1 or 2 when we had done the statement. We had learned how to do this. So we take the end balances from the statement of shareholders' equity, and we just write those in the equity section. And that's how these questions are done. Again, to summarize, you just have a fixed number of journal entries associated with this type of question. You have your issue of shares, which is a debit to cash because you're receiving cash when you're issuing shares, and you're crediting common or preferred shares. And remember to put the dollar amounts here. Do not put the number of shares ever. Next, you have issuing dividends. Remember, this almost always happen in 2 different steps. So first you're declaring it. So when you're declaring it, you have a debit to retained earnings. Remember, dividends are paid out of retained earnings. I hope that remains with you during your exam and you can literally hear me say it. Dividends are paid out of retained earnings, okay? And then you're crediting dividends payable. And after some time, when you're paying off the amount, you'll then debit dividends payable. And at that point, you'll credit cash for the same amount. Now, the last journal entry that we'll be dealing with for equity is repurchase of shares. And remember, this has 3 items in it. So there are 2 debits and 1 credit. So we are paying cash to repurchase the shares. Obviously, a credit is cash. And since we are repurchasing the shares, the number of shares in the markets decrease. The way we decrease common shares is by debiting it. So one of our debits is common shares. And whatever the difference is will flow to retained earnings. Now you reduce, so here, your first credit, your cash amount, will be how much of a cash the question tells you paid to repurchase the shares. Your common share amount will go down by the average share price. So you take the number of shares, you take the total value of shares, average share price is equal to value of all shares. So that's all common shares divided by the number of common shares. This will give you an average share price. You take the average share price, multiply it by the number of shares that you're repurchasing, and that's the value that you'll get for common shares. It will always be that the common shares value that you get is lower than the cash value, and the difference between the two will flow to retained earnings here. And that's how you do equity. It's, again, fairly easy. If you try solving a question on your own, it's easy marks that you should be getting for sure. Thank you.